Okay, good afternoon and welcome to CEPR. I'm excited to welcome all of you here for today's talk by Karen Dynan from the U.S. Treasury Department. I'm Mark Duggan. I'm the director of CEPR. But before I get to introducing our speaker, let me tell you a bit about what we have coming down the pike here at CEPR in the coming weeks and months ahead. So 2 weeks from today, we will have an event with the president of the American Enterprise Institute, Arthur Brooks, who will be talking here about poverty and markets. Exactly 1 month later, on December 1st, we'll have our annual State of the West conference, which we co-organize with the Bill Lane Center for the American West here at Stanford, where we will have, we'll be hosting the governor of Idaho, which is in the American West, the Premier of Alberta, Canada, which I have not checked I don't know my Canada geography very well, but I have been told that it is also in the West, although it's in the North American West. We'll also have sessions on healthcare and immigration, and I think it's going to be a really terrific event. In the following month, January 19th, we're very excited that we'll be hosting Janet Yellen, the chair of the Federal Reserve Board of Governors, and we have many more events in the meantime, including our annual economic summit on Friday, March 10th, where we host leaders from academia, from business, from policy, including people you might have heard of, such as Larry Summers, Condoleezza Rice, the CFO of Google, Ruth Porat, and the CEO of Uber, Travis Kalanick. So we have a terrific lineup for that, and we're looking forward to that and lots more in the months ahead. So let me pivot now to introducing our speaker, today's speaker, Karen Dynan. Karen serves as the Assistant Secretary for Economic Policy and as the Chief Economist at the U.S. Department of the Treasury. In this role, she heads up the Office of Economic Policy, which is responsible for reporting on current and prospective economic developments and assisting in the determination of appropriate economic policies. From 2009 to 2013, Dr. Dynan was the Vice President and Co-Director of Brookings Economic Studies Program, and before that, she served on the staff of the Federal Reserve Board for 17 years, most recently as a senior advisor, where she played a hugely important role in macroeconomic forecasting and analysis of household and real estate financial conditions, and the policy response to the 2008 financial crisis. She's also served at the Council of Economic Advisor and on the faculty at the Johns Hopkins University. Dr. Dynan is an expert on macroeconomic policy and household financial issues who has published very widely in leading economics journals, and she received her PhD from East Coast institutions, though we're very happy to welcome her here to the West Coast from her bachelor's degree from Brown University and her PhD from Harvard University. So please join me in offering a warm welcome to Dr. Karen Dynan.
Thank you. Good afternoon, everyone. I guess I'm glad you have the CEPR slide up there, because I just want to start with a word or two about CEPR and why CEPR is important to me. So people out there, are there people out there who know the musical Hamilton? Okay. So I'm a fan, of course, as is kind of lots of people at Treasury, just because it's never, again, going to be as glamorous as it is right now to be a Treasury official, thanks to the musical Hamilton. But anyway, the reason I bring it up is that if you are a fan of the musical Hamilton, you know that kind of in the DC policy world, it's really important to be in the room where it happens. And you know what I mean, I think the modern day equivalent is just the room or the discussions we have where we're really doing the kind of heavy lifting to kind of define and refine and evaluate the policy proposals that we're going to propose and push. And you know, it's a pretty crowded room because lots of people need to be there. You're going to need the people who are institutional experts in the area at hand, and you're going to need kind of lawyers. You're going to need people who work on legislative affairs, the people who do public affairs. So it's a crowded room, and people do get apprehensive about whether they're going to be invited into the conversation. But the economists, they actually always get invited, and that's been, that's been great. That's just something really good that I've kind of experienced in the 3 years that I've been at Treasury. And the reason we get invited is because we come in and we have kind of the data and the analysis and the access to the academic research that basically defines the economic trade-offs that are involved in any given policy decision. And I should say right away, the economic trade-offs, they don't always carry the day. You probably know that. But in my experience, in the 3 years I've been at Treasury, I just have to say that people always do want to understand those trade-offs as they are making decisions. They always want the economists to be part of that conversation. But anyway, that's where CEPR comes in, which is that I cannot kind of emphasize just how important it is that we have the sort of rigorous, policy-oriented academic research that scholars at CEPR are putting out as we go into those meetings and kind of discuss the trade-offs. They just make such a difference in making sure that the trade-offs are understood to the degree possible as these policy decisions are made. And the fact is that when we understand the trade-offs better, the economic trade-offs are more likely to carry the day than other considerations. So I just want to say that that's why the work that CEPR is doing is so important. And I just want to thank I hope CEPR will continue to do all this wonderful work. And I just want to thank everyone in this room for making that work possible. Anyway, okay, so that's CEPR. Let me get on to my talk. What I'm going to talk about today is I'm going to talk about economic growth, some challenges that we're facing. And then I'm also going to talk about some household sector issues that relate to those challenges. And I'm going to wrap up with a discussion of what this implies for economic policy. Okay, so one of my jobs as chief economist at Treasury is actually forecasting the economy, where it's going to go over the next 10 years. It's an input to the president's budget numbers that they put out every year. As people probably know, that most forecasters these days, they think that once the dynamics of the recession and the recovery are played out, they think that the economy is basically going to settle into a growth rate that's probably in the low 2s. It's probably 2% or a little higher. And that's not as fast as growth rates that we've seen historically. So I want to talk about these challenges because they are reasons why we're not going to see more rapid growth, or are likely to not see more rapid growth. So the first challenge is falling labor force participation. So the labor force participation, that's the fraction of the adult population that's in the labor force. So they're either employed or they're unemployed, looking for a job. And what you can see in this picture, you can see that there was a big run-up in labor force participation in the latter part of the last century, and that was largely because women were flooding into the workforce. But then labor force participation, it peaked around the year 2000. It's come down since then. The rate of decline accelerated around the time of the start of the Great Recession. So there are various factors that feed into this pattern, and I'll come back to that in a few minutes. But the point I want to make here is that basically this is very relevant for what the growth rate of the economy is going to be. So the Congressional Budget Office estimates that what they call the potential labor force, one key determinant of economic growth, is now growing 0.5% per year, compared with 1.6% in the 1980s. A second challenge is a downshift in productivity growth. So productivity is the amount we produce per hour of labor. What you can see in this graph is you can see average annual productivity growth for different sets of years. And productivity growth, it tends to be quite volatile on a quarter-to-quarter basis, but economists have identified kind of these eras of productivity growth when it's been lower or higher. So, starting with the first, basically, quarter century after World War II, we actually saw brisk productivity growth. And that is thought to have been supported by a variety of factors, including the commercialization of World War II technologies and some big public investments like the interstate highway system. As those factors played out, productivity growth slumped in the early 1970s. Other factors that might have been contributing to that slump might have been the oil price shocks that kind of wreaked havoc with firms' production processes. And then that went on for about 20 years. There was a short burst of higher productivity in the mid-1990s. It lasted for less than 10 years, but it popped back up again. That's thought to be largely due to the IT revolution. But then, in the early 2000s, we started a new era of slower productivity growth. Bunch of kind of, there's a bunch of discussion about why we've downshifted, and the answers are not fully understood, but we do know that part of it has to do with a slower rate of technical advance, and also, particularly recently, a lower rate of business investment. Okay, so a third and related challenge is what economists call declining fluidity or dynamism in the economy. And I popped a graph up here that shows trends in various measures of dynamism in labor and product markets. So you can see job creation, job destruction, a downtrend over time, firm entry, firm exit, downtrends over time. This is showing up across a very broad range of indicators. It's not just in these series. You see it in job-to-job transitions. You see it in interstate mobility. Just a whole bunch of evidence that we're seeing less dynamism in the economy. And the reason this is important is that although kind of dynamism, this kind of disruption, there is a bad side, there's also a very good side, and that is that, for example, in the labor market, job-to-job transitions, those are important events where workers often get matched to, they have a chance to renegotiate their contracts, but on top of that, they get matched to jobs that maybe they have a better fit for, and therefore you get higher productivity out of that. In product markets, with the firm entry and firm exit, when you have more firm entry and more firm exit, you tend to have more younger firms in the economy, and younger firms are responsible for more innovation. So these trends, downtrend and dynamism, this is thought to be contributing to the productivity problem. So those are three challenges. You can consider them from several interrelated perspectives. There is the business side of it. There's a whole bunch of things I could tell you about that. There's the role of government policy. And then there's the household side of it. And what I'm going to do today is I'm going to focus in on the household side of it, partly because the work we're doing at Treasury, we're doing a lot of work on kind of the household side of it. Partly because I think we're often talking about the business side of it, business tax reform, trade agreements. So I just thought it would be interesting to spend a little time on the household side of it. Okay, so let me tell you about 4 household sector factors that are creating challenges for economic growth. Just to preview, I'm going to talk about population aging. I'm going to talk about the long-term downtrend in prime age labor force participation. I'm going to talk about a lack of good financial opportunities for households. And then lastly, I'm going to talk about limited access to high quality higher education. So starting with population aging. I think most people know this, that the economy is getting older. The share of the economy 65 and older is rising rapidly. Here's just a graph that sort of illustrates that it's rising rapidly. The share today is about 15%. 10 years ago, it was 12%. 10 years from now, it's expected to be 19%. So the rate at which it's getting older is actually accelerating a bit. This is going to, I should say, first of all, before I get into the economic challenges, I should say, we know this is going to create fiscal challenges, and that's a topic that has been discussed widely. We know that our big entitlement programs for older people, Social Security and Medicare, we know there are going to be solvency challenges for those programs, and we know that we're going to need to do reform, and that we should get started with reform sooner rather than later so people have time to adjust to it. So I wanted to say that, but that's a topic for a different talk. What I want to talk here is about why it matters for economic growth. And the reason this matters for economic growth is because it's damping growth in the labor force relative to the historical experience. Another channel through which it's probably influencing economic growth is that it's probably reducing dynamism, because older workers are less likely to change jobs, they're less likely to form businesses, and they're less geographically mobile. So all those things are kind of reducing dynamism in the economy. We don't think these demographic forces are at all the only explanation for the trends I showed you earlier about dynamism, but we think they could be a material component of that. Just to give you a sense of how important this trend is for falling labor force to participation, if you look at the decline that we've seen since the beginning of the Great Recession, economists think that about 2/3 of the decline comes from population aging. Population aging is expected to weigh on labor force participation by about 1/4 percentage point per year for the next between 10 and 15 years. Okay, so that is population aging. The next thing I want to talk about is the long-term downtrend in prime age labor force participation. In some senses, I think this is kind of a more interesting question from a policy perspective than the effects of population aging on the labor force participation rate, just because we're not going to repeal the baby boom, although there might be more we could do to get older workers to remove obstacles to them participating in the labor force. Anyway, this is prime age labor force participation rates for males and females separately. Prime age, it's 25 to 54, so you're abstracting from the retirement of the baby boom, the effect of that on the labor force participation rate. You're also abstracting from what's going on with younger people. They're participating at lower rates because they're going back to, or because they're getting more education. So anyway, just starting with men, there's been a pretty steady kind of downtrend for male labor force participation rates. It's been about 10 percentage points over the last 60 years. Given that they're such an important group in our labor force, this is a pretty important downtrend when it comes to thinking about economic growth. Downtrend is not fully understood. There's a lot of research around the question. My colleagues over at the Council of Economic Advisors actually put out a paper on this. It was a month or two ago. It's actually quite a good paper, and I recommend it to people if they're interested in the question. They came to the conclusion that that one important force was a lack of good or a growing lack of good opportunities for prime age male workers, and that could be stemming from just the loss of kind of middle-income jobs to automation or to overseas competition. So they pointed to that as one factor, and that's consistent with the fact that we've seen the biggest declines in participation for low-skilled men. There are probably other things at play. There are questions about the role of the more generous disability benefits. Mark's actually done some good research in that area. People are looking at kind of the role of growing incarceration on male labor force participation. Alan Kruger just had a nice paper out in the last couple of weeks that talks about how maybe poor health is playing a role in this downtrend. For women, you can see the period where they were flooding into the labor force, but you can see that basically over the last 10, 15 years, they've settled into a trajectory that looks a little like male prime age labor force participation. Again, that is a phenomenon that people are studying, they don't fully understand. I actually think it's kind of interesting to look, well actually I'll get to this in a minute. So anyway, as I was saying, a variety of factors are probably contributing to these trends for prime age workers. As with population aging, they're important because they're damping the growth rate of labor supply. And here's where I was going to say it's kind of interesting to look at international comparisons, partly because they suggest the trends might not be immutable. You can actually look at how female participation has trended relative to other countries. And one interesting thing I think about this graph is, you can see actually in the 80s and 90s, we were kind of marching up with other countries in terms of prime age female labor force participation. And then, as you saw on my graph, came to a peak and it started to go down again. The interesting thing is that many of these other countries, female participation just continued to increase. So I think it does, I think that the glass half full implication here is that maybe there is something that we can do about this, and I'll get to this later in my talk. I should say that one question I always get right off the bat is does this have to do with kind of family, our labor market being less family friendly? And there is some work that suggests it might partly have to do with that. Okay, I can see I know we're getting tight on time, so I will go through the rest pretty quickly. I would say a third factor we want to be thinking about is a lack of good opportunities for some financial opportunities for some households. These opportunities are both on the credit side and they're on the savings side. The crisis illustrated the dangers of too much debt, but it's important to recognize that access to credit can be too limited as well as too loose. Graph here, just to illustrate, a graph here of mortgage originations by credit score. And what you can see in this graph is that if you look at borrowers with credit scores less than 660, that's the black area and the light blue area, you can see that there's almost no mortgage origination for that group post-crisis. People sometimes say, well, maybe that group shouldn't be getting any mortgages. I just want to point out that you can look back to kind of you can look back to the early 2000s before we got into the kind of frothy period of the housing market, and you can see they were seeing considerably more originations in that part of the credit distribution. On the savings side, low levels of accumulated financial assets suggest that households may also lack good saving opportunities. This graph it shows financial assets of households with heads aged 45 to 54. So this is an age when people should have been saving for a number of years already. And what I've done is I've done median financial assets, but I've actually I've translated into weeks of income just to kind of normalize it. And what you can see is that in the lowest quintile of the net worth distribution, households have very, very little in terms of either liquid assets or financial assets, but I actually think the more interesting thing to look at is if you go up a quintile in the net worth distribution. So this is the 20th percentile through the 40th. They have more assets relative to the lowest quintile, but in absolute terms, this is just not a lot of savings. I mean, their liquid assets are about a week's worth of income, so maybe not even enough to cover their cars breaking down. Okay, this matters because both access to credit and low saving, they make it hard to invest in an education, to start a new business, to relocate geographically or take a new job if doing so requires short-term expenses. And also households will generally be less resilient to shocks to income and consumption needs, which is also bad for growth. Okay, a fourth issue I want to talk about is limited access to high-quality higher education. Okay, slide here. People probably already know this. College remains a great investment for the typical student. Lots of complicated ways to show this. I'm just going to show a very basic graph of median weekly earnings to show you just how much higher someone with a college degree, just how much more they earn than people with less education. There's a but though, which is that there's a literature that's documenting how some institutions are absorbing a lot of public dollars in terms of grants and loans, and yet Oh, and a lot of student time, but they're delivering little value. And I can't really, there's good work by Adam Looney, who's my colleague at Treasury, and Konstantin Yannelis, who either is or was at Stanford. Use bar steeper. Okay, very good. Okay, exactly. Okay, so it's actually documenting how students at certain types of non-selective schools, for-profits and other non-selective schools, how they are actually, borrowers there are seeing very poor outcomes and absorbing a lot of public dollars. So these graphs don't really do their results justice, but you can see, first of all, this is for-profits in the left and selective on the right. First of all, you can see just how much growth there was in terms of borrowers in the for-profit sector in the first decade of this century, and just how many borrowers were entering repayments. That gives you a sense of the size of the problem. But you can also just see how poor the outcomes are. So a quarter of those borrowers were in default 3 years after they started repayment, largely, we think, because their income outcomes were poor. Okay, so I'm going to quickly take you through some policy recommendations for addressing these issues. I'm just going to kind of run you through the various explanations. Probably won't give you a lot of detail on any, but I want you to see kind of the various things that we've been working on. So recommendation 1 is to use, it's actually a macro recommendation, and that is to use countercyclical policy to support aggregate demand in the face of macroeconomic shocks. So we know that macroeconomic shocks, they cause immediate harm, but kind of the bigger question when it comes to long-term growth is that they can have lasting effects on both on households and on the economy more broadly. So they can deplete the financial assets of households. They can lead to credit problems that reduce long-run access to credit. Prolonged unemployment can reduce labor force attachment. So just the recommendation is, in addition to using appropriately strong discretionary responses of monetary and fiscal policy, we would be well served by more automatic fiscal stabilizers. Okay, recommendation 2 is use other types of policies to encourage labor force participation. Okay, we can have policies that ease the transition to new jobs for people who lose jobs through policies such as strong unemployment insurance, wage insurance, retraining opportunities. We can encourage work among groups with particularly low participation through policies such as an expansion of the earned income tax credit. We can provide more support for working families through policies such as increased subsidies for childcare and expanded paid leave. And we can reform institutions that create obstacles to getting better jobs. This is an area that my office has been doing a lot of work on. We can reform our occupational licensing system and the laws governing non-compete agreements. Okay, recommendation 3, provide households with more good opportunities to borrow and save. So on the credit side, the administration has already engaged in efforts to broaden the availability of mortgage credit. We should continue those efforts. At the same time, we also have to continue the efforts to reduce the exposure of households to the more harmful aspects of debt use. And there's a new Consumer Financial Protection Bureau that's doing good work on that front. Okay? On the saving side, and this is work that scholars at CBER I know are engaged in, we need to make steps to make saving easier and more automatic. So the main way that policy now is trying to encourage saving is through features of our tax code that basically raise the after-tax return to saving. Turns out that there are a lot of households who aren't very responsive to that. So we need to take steps to make saving easier and more automatic. This would include automatic IRA programs at the state, preferably the national level, to get more people into plans where the saving is just done through automatic deductions from payrolls so that you don't have to think about it. And we should provide greater tax credits for firms creating workplace savings plans. Okay. I'm just going to wrap up with a recommendation on the higher ed side. We should increase access to higher education, but we need to construct the system so as to limit abuses and increase accountability. So a bunch of proposals the administration has made to make higher education more accessible, particularly for low-income students. You can have more generous grants, greater support for community college. But we need to couple those efforts with policies that are going to incentivize higher education institutions to provide educations that pay off. Okay, so reforms to encourage college completion, and more policies to hold institutions accountable for providing educations of little value. So we have some regulations now that we've finalized. They're called the gainful employment regulations. They'll cut off access of certain higher ed programs to the student loan system if they have, if they're particularly egregious outcomes. But really, we need to kind of broaden those. We need to do more thinking about how to broaden those sorts of incentives. Whether it's so, for example, some members of Congress have suggested that maybe schools should have to have a financial stake in the loans. You know, in that maybe they'd have to pay back some of the loans if students, they were seeing students that were not able to pay back their loans on a large scale. So with that, I will end there, but I want to thank you very much.
That's great, thanks. Okay, great. So I'll start off with just a few questions for Karen, and then open it up for questions from the audience. And it would be great if at least one student, and hopefully more, would ask a question at some point today. So one thing, you went through a bunch of possible policy recommendations, and you know there are others that are not on this list: corporate income tax reform, trade policy, TPP, that kind of stuff. So that is a whole nother area. But I'm wondering if you have a sense from looking at this, and if there's a sort of conventional wisdom in DC or among the experts in DC on sort of where among these things are we likely to see, would we be likely to see the biggest bang for the buck? Because you know many of them sound very good, but it's hard to, right now we have a decent sized deficit, we have these fiscal challenges on the horizon, so it's not obvious we have a ton of wiggle room. So where would you, to some extent, if you were to sort of think about all those things you put up there, where would we, if you could pull the lever on one or two of them, where would they be?
I mean, it's really hard to pick favorites. I mean, you are right that we live in a constrained world, though. I will say, you know, there's this exercise that the administration does is that we put together this budget every year. It's basically a set of budget proposals, and we release it every February. And you are able to, so a lot of what I talked about today and a ton of other policies are incorporated into our budget. If you pair them with other sorts of proposals to increase, for example, to increase revenue or cut other types of spending, you can kind of achieve a sustainable outcome. So we do have this budget that shows, by our calculations, that basically you could make these investments while keeping the debt to GDP ratio stable. But anyway, that's not answering your question. So let me try to answer your question. I think some of the most important things are measures that actually serve a couple of different purposes. So for example, the earned income tax credit, expanding that, I think that's a really big idea. First of all, because it's shown to be a really effective anti-poverty program, but also the expansion that we proposed, which is making it much more generous for workers without children, we think could really move the needle on labor force, on labor supply. I should also say it's a proposal that, in general, has more bipartisan interest, especially if you're talking about comparing it to another way of achieving some of the same goals, such as raising the minimum wage. So I like the earned income tax credit. I would say the other set of proposals that I think are just important are the ones that go at trying to increase worker skills, whether it's through the higher ed system or whether it's training, providing more training for workers, and that's just because those are policy initiatives that both increase kind of overall growth, but they don't have that kind of age-old trade-off between equity and efficiency, because they're also going to kind of lift workers in the lower part of the income distribution, and they're going to help address inequality.
Okay, great. Another question I have for you, you didn't mention it in your slides, but I'm curious, and it's related about one issue that came up in so we had a housing policy forum this past week on Friday, where we brought together people from business, academia, policy to talk about what's happening in the US and housing market and here in the Bay Area. And one really interesting statistic that was put up, a time series of sort of what's been happening to the share of people, let's say 25 to 34, who live on their own. And then they're like broken out again by the share who actually own a house in that category. And that's been falling pretty steadily and quite rapidly over a long time period. And this may become more relevant to you because you're the proud mother of twin 21-year-old daughters, right? And so this statistic could be more on your radar screen in the months and years ahead. Yeah. So I'm curious whether you see that as a symptom of some of the issues that you've been highlighting, or something that should be more of a focus, because to the extent that the rate of new household formation slows, there's just a lot of economic activity associated with when a new household gets created, and you buy a place or you're fixing it up or what have you. And to the extent that that's becoming much less common, that might be a bit of a drag. So curious thoughts on that.
Yeah, so there has been a material rise in the fraction of people in the, I think it's like the 25 to 34 age group, who are young adults who are living with their parents. Do you remember the exact statistics?
I don't remember the exact statistics, but it was high.
I think at one point it was like 1 in 10, maybe like 10, 15 years ago, and it's gone up to like 1 in 7 or something like that, but you should check that before you quote me on that. And it's not well understood. People have proposed a variety of explanations. The explanations, they go from kind of the more benign factors. So, for example, the age people are getting more education. The age of marriage for more educated people is traditionally kind of later. So some part of it may be kind of just a benign thing, that people are not kind of getting married as earlier because for whatever reason more educated people don't. Other people talk about the fact that millennials seem to like their parents better. And I mean, there's survey data to support this. And I think millennial parents like their children possibly better. I don't know. You find them more agreeable to live with? I don't know. Or maybe they just take a softer view towards that. But that's kind of in the more benign category. I think the more concerning category is that just maybe they're not financially able to go out on their own. So the explanations there are kind of scarring from the recession and financial crisis. We know there's a cohort of young people who came out of school whose first jobs were not as good in some respects, as their counterparts who came out of school when they were at a time when the economy wasn't so weak. Versus student loans have been discussed as a factor. Literature there, it's something we need to be thinking about. It's unclear how big a role. Literature doesn't really kind of document it well. My reading of the literature is that it does seem, there's some evidence that having student loans seems to delay home ownership. Maybe that's contributing as well. And then also related to homeownership, above and beyond student loans, we're just in a world where down payments are higher than they once were. We're just requiring, post-crisis, we're requiring higher down payments. So maybe you want to be in home to save.
Interesting.
Yeah.
So, okay, that's great. And you did put up one slide that was, so Karen also this morning was very kind to give a guest lecture in my Econ 1 class, and I think there may be a couple Econ 1 students here. So that was a big crowd, and you put up a couple figures, one for women and one for men, looking at the labor force participation rate. And with this being an Olympic year, and you get reminded of the Olympics a lot here at Stanford, because like every other student practically is like a medal winner or something. So in Olympic years, I kind of feel competitive with other countries, and looking at the medal count, how are we doing on the golds and the silver. So I did a lot of that back in August, and the figures that you put up kind of horrified me, the one about female labor force participation. Then you also showed it for men in Econ 1. It didn't make the CEPR slide deck. But relative to other countries over the last 25 years, 30 years, our labor force participation rates, we are now behind Sweden, Japan, France, the Netherlands, and all these places for people who are 25 to 54 years old. And that, it's kind of stunning at some level.
It is.
And so to what extent do you, at some level, so the EITC, I could see that one moving the needle somewhat on this, but do you see the possibility of some kind of big tax reform influencing that? And what the kind of thing I have in mind is, suppose one thing in the US, people are taxed at the household level as opposed to at the individual level. So let's say the second earner, their marginal tax rate, especially here in California, where the marginal tax rates rise with income, is taxed at a pretty high rate. If you have a couple, let's say they're both earning like 60 or 70K, and one of them can earn 60 or 70K, and one of them is thinking of not working. Here in California, you can definitely easily get to marginal tax rates of 40 or 45% when you factor in the payroll taxes. So do you see any? I've heard like a couple of little policy proposals of moving from a sort of household-based tax system to individual. Is that kind of anything? I haven't heard anything about it in this campaign, though. I mean, I don't know what. I'm not going to get into that. But so can you just comment on this? Like this labor force participation, it's stunning. And what so EITC, I could see giving us a couple percentage points or something, but it does moving it in a better direction. Seems like a pretty high priority.
Yeah. So I mean. So I did show, the graph I showed for men this morning showed that a bunch of countries have kind of experienced a decline, but the decline we've experienced in this country has been the second largest in the OECD, and we're now down to, I think we have the third lowest prime age male labor force participation rate. I mean, the caveat to the international comparisons is that like, these countries are all very different, and they have kind of different populations with different particular challenges. I kind of like to think of these graphs. I mean, I think that I'm a natural optimist, so I think of this as like this is the glass half full, interpretation, which is just that if other countries can do it, maybe we can do more as well. I think on the particular, but I do think there are things to be learned. We should be doing more of the studying, kind of why we see these differences across countries. I will say that there was a study by Francine Blau and James Kahn on the question about women and the role of, whether differences in the family friendliness of the different policies explain the relative performance of different countries, and they came to the conclusion that it was a quarter of the. So
child care isn't subsidized as much, for example, here in the US.
On your specific question, that is something that people do talk about in terms of the international comparison, because a lot of these other countries do tax at the individual
level, not the household level.
The administration has not come out in favor of that big a change to the tax system, but we did actually, in recognition of that, in our last budget, we did have a proposal about, I can't remember exactly what it was, but it was something that offset to some degree the higher marginal tax rate on the second earner.
Second earner, yeah, okay. Yeah, Okay, so now I'm going to open it up for questions from the audience and to see whether we have some questions. I have plenty here, so I can keep going, but I would like to see a question. Here we got a question from a student right back here, Ben.
Sorry. Thank you. I'm in the Econ 1 class as well, so thank you for speaking this morning. One of the things you talked about this afternoon is the difficulty in access for the lower quintiles in income to savings and to credit. Obviously, it's more expensive or carries higher risk for banks to make loans to those quintiles of the population. Do you think that there may have to be reforms to some of the stress tests or Dodd-Frank to make it easier for banks to make loans to those groups of the population?
So the financial regulation, kind of not particularly in my wheelhouse. So I'm going to just defer to, you really should get my colleagues in from our domestic finance part of Treasury, but I will say to speak to the specific question of the stress test, I will say that this issue about, obviously no one wants to go back to the kind of risk-taking that we saw immediately prior to the crisis. It's not clear, though, whether these households at the bottom of the credit distribution, that they are, it's not at all clear that kind of lending to them is somehow putting the financial system at more risk if you have appropriate kind of risk-based pricing worked into the lending system. And I touched on it briefly, but in my own presentation, I basically showed that we were lending to them even before we got to this kind of really bubbly period in the housing market, and that seemed to be working out fine. I will also say that there's some really interesting new research out of the Boston Fed that's showing that contrary to the kind of the common narrative that somehow these households at the bottom part of the credit distribution were disproportionately responsible for the financial crisis, that's really not the case, that actually the increase in borrowing and the increase in risk-taking really happened across the income and credit distribution. It wasn't just those guys who were kind of doing all this borrowing prior to the financial crisis. It really was households much higher up in the credit and income distributions, and it was that. And then if you look at the kind of the performance of these loans, it was really, kind of, actually those guys higher in the credit distribution, they're actually they fed into the problem worse because they had bit larger loans. So I don't think that is the issue when it comes to kind of increasing the availability of the credit for higher risk households. I think banks are kind of more reluctant, as you could see, to lend to those households. In recent years, there are a variety of factors that are contributing to that. Some of it is that as yet, kind of the rules, the repercussions to kind of to the bank's responsibility if they've made a bad loan are not. There's some view that they haven't been clarified sufficiently. The big government entities involved in making loans are working to correct that.
Additional questions here at the back?
Thank you. Have you crossed the health of the nation against your data? And I'm thinking about the 85 million Americans with prediabetes, the obesity epidemic, the recent decline and trend in life expectancy in America, and the impact on productivity, impact on working population.
The impact on productivity in the working population. So it is something that we think about. There actually is some new, very interesting research out from Alan Kruger within the last couple of weeks, looking at male labor, maybe it's male and female labor force participation, and why there have been a growing fraction of individuals who are what Alan called idle, meaning not in the labor force but not in school either. And he finds in his data that a significant number of them are reporting significant health problems, like an inability to climb stairs or to get out and do errands. And it's something like half of them report those health issues, along with a considerable amount of pain and use of medications. I think I thought it was an interesting paper. Alan was constrained by data limitations, that it was really a kind of a snapshot in time, just because the questions he was using, some of the data he was using was just kind of recent data. He was not able to explain whether these things are explaining the trends. But I thought it was an interesting paper and one that will hopefully start more research in this area.
Yeah, right here. Yeah, you. Sorry.
So Alan Kruger got a lot of attention with his article. I'll extrapolate from it, and this is more of a rambling statement than I'm given to making, and I'll try and fit a question in here, but I'm a little stunned that the policy recommendations that you list sort of sound like something that we could have seen 10 years ago, or 20 years ago, or 30 years ago. And that doesn't seem to connect to me with what Marcus correctly pointed out, with this very dramatic data on labor force participation by cohorts, by gender. And I suppose I am a product of this world. We tend to think that there's a lot in this world and in this labor market and in this industrial structure that has changed because of the things that we do here and elsewhere in technology. So is it really this simple? Is it just the same recommendations as what were there 30 years ago? Or does policy recommendation need to be more imaginative to fit with the new world?
So I'm
in 10 words or less, I'm sure.
So I guess I'm gonna a little bit challenge the notion that these are the same old recommendations. I mean, some of them are the same recommendations, and some amount of that is that we have had some really good policy innovations, like the earned income tax credit, and as we've studied them, we've just realized that they're worth, I'm not sure we're doubling down on it, but it's worth pushing harder on those fronts. But I do think there have been there's been some innovative thinking. So for example, in the saving realm, our tax code, or really the way our current set of federal policies mostly try to encourage saving is through by increasing the after-tax return to saving. And there has been research within the last 10 years, 10, 15 years or so, much of it coming out of CPER scholars, that have really showed that there's a significant portion of the population that's just not very responsive to those sorts of incentives. And what you really need to do for those households is to make saving easier and more automatic. So it's kind of the power of getting people signed up for kind of workplace savings plans where the money is just deducted from your paycheck and you don't, with good defaults, so that you're just like put into the system and you don't have to really think about it much. And I think that's something that really has changed in the way people think about saving policy. There's much more of a kind of push in that area. I would say in terms of higher ed policy, we have always thought, well, we should kind of do things to increase the access through grants and through loans. But On the other hand, just the experience of the last 10, 15 years with the big expansion of the student loan portfolio and kind of seeing a lot of defaults and for certain types of borrowers, it's made us kind of think more about increasing the accountability for schools that aren't delivering value. So I think there have been some innovations there. Does that mean that we don't need more innovations? No, we should be thinking all the time about like what else can we do, and I hope CPR will be doing that.
Well, just following up on that, I mean, it's possible that the things that would move the needle most are outside. You boxed in, you had sort of business, government policy, and households, and we sort of zoomed in on households. It could be that corporate tax reform is a bigger deal, or trade policy is a bigger deal, and I won't ask you to comment on where trade policy is headed. But it could be that and to get back to that kind of bang for the buck kind of issue, it could be that those places would move the needle more.
Yeah, and I didn't mean to say, I focused in on households. I mean, as you could see, like just doing that piece of it was just like, was like a huge talk in and of itself. But I should say the business, some of these other things are very important to the economic challenges. So agreed, business tax reform, really important. Increasing the public capital stock through more infrastructure spending, very, very important. I put that very high on the priority list. Trade, I will say, at least this current administration's position is that, I mean, we will continue to push for TPP through the end of the administration because we think it would be beneficial it would be beneficial to the economy as a whole. That's not to say that it should not be coupled.
Right.
I think it's a big lesson that economists have learned over the last 10, 15 years, that it absolutely needs to be coupled with policies that address the distributional consequences.
Okay, one more. We have time for one more question. I'm going to flip a coin between these two students right here. So, Celia, you decide. Let them duke it out.
So I know if you're talking about the earned income tax credit, oftentimes with disability benefits, we see that people often drop out of the workforce if they have a small disability, even though they probably could keep working because they'll get those disability benefits. And I know that sometimes when people work more, they'll often move up a bracket with welfare systems, with tax brackets, and so they'll often end up paying more than they've earned. And I was wondering if there's anything besides the earned income tax credit that you've been looking at reforming or reforming incentives around this area.
So I'm trying to, so the earned income tax credit, so you're talking about the high marginal tax rates that come from phasing benefits out. I'm trying to think if there are other policies in that realm, and none are particularly coming to mind. I do know that some of our work, we've done a lot of work on the Puerto Rican economy, and their kind of the way some of their social programs work, including food assistance, have created some pretty big cliffs. And we've worked there to try to think about what one could do to provide benefits in a way that there weren't these big cliffs.
Good. Well, we are a minute over, so I think we should wrap up there. So please join me again in thanking Karen Dynan for coming to CPR.